Hello and welcome everyone to this weekly market recap for the week ending April 11th, 2025. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and it's a pleasure to be with all of you again this weekend. Quite a week that we saw last week. Kicked off earnings season on Friday. Had a couple of the banks come in pretty strong. JP Morgan, another pretty good report there. That helped the market a little bit, I think. Also, we had a really big week in terms of the tariff news. On Wednesday, President Trump announced that we would be pausing the tariffs against most countries for 90 days. And the market responded, as you probably would expect, after going down because of all the tariff news and announcements and so forth. We saw a big rally on Wednesday after that announcement came out. Saw really a lot of gap ups, gap downs. I mean, it was pretty wild week. Volatility index soaring up to levels really we haven't seen in many years, near 60, 55, 60 on the VIX. So it was pretty crazy. Economic reports came in better than expected, except for one that I'll talk about in a minute. But we had two big inflation reports. And quite honestly, I don't even know if the market's paying attention to the inflation reports right now. I think tariffs are kind of leading the way in terms of the news that the market's paying attention to. But we had two really good inflation reports that came out. The CPI for March was released on, I think on Thursday, and that showed that the core CPI rose just 0.1%. The market was expecting 0.3%. And then the core PPI the next day came in even better. I think, let me see, I have that number up here. So the PPI for March came in at, the core number came in at minus 0.1, which was 4 ticks below the rise of 0.3% that was expected. And at the headline number was actually expected to rise 0.2%, and it fell 0.4%. So, I mean, these weren't just, coming in just a little below expectations. These were really good numbers to come in on the inflation. But it seemed like, at least in the media, a lot of the attention went to the consumer sentiment report on Friday, where we showed the lowest reading on consumer sentiment, or just about the lowest reading we've seen in the last 50 years. And I have a really interesting chart to show you about that. But, it sounds on the surface like that's horrible, and it is in terms of sentiment. But that doesn't necessarily mean that it's going to be horrible for the stock market. And again, I'll show you a chart later in the show to kind of, give you a little bit more of a visual there. But overall, I mean, we did finish up nicely, but that was after we'd had the huge drop last week or the prior week. And so last week we started off low, got down below the 5,000 level, and then we came roaring back, especially on Wednesday, midday, when all of a sudden the market just took off, and we saw just incredible buying in the afternoon on Wednesday. I think the NASDAQ finished with its second best day ever. I mean, we're talking about going back to the 1970s. So second best day ever is pretty significant, but you got to keep it in perspective. I mean, we went from 5,500 down to 4,800 and change prior to that. So yeah, getting back 500 points, I'm talking about the S&P 500 now. But getting back 500 points or 450 points, whatever it was on Wednesday on the S&P 500 was nice. But when you consider we just gone down 700, yeah, the net doesn't seem quite as exciting. Anyhow, let's move on. I want to go over some of these numbers with you, show you some interesting charts that you probably haven't seen. Media doesn't show you the charts that really matter. They just want to scare everybody, try and get those clicks going. But take a look at the action on Friday first. So here's the Dow Jones Industrial Average finishing up 619 points. The S&P 500 was up 95, getting back to 53.63. Still got a long way to go to get to 55.21. And to me, that's the key resistance level right now on the S&P 500. So got some room to the upside, also got some room to the downside. We set that low, I think, around 48.30 recently, or 48.35, something like that. And the prior high, if you go back to 2022, before we had the bear market, was right at about that 4,800 level. I think the intraday high back then was 48.19. So that 4,800 to 4,820 area, pretty important. for the bulls to hold that level to the downside, which now is 500 points away. But the way the market's moving, that could be a day or two. But the upside's at 55.21 level. So those are the two key areas I'd be watching on the S&P 500. NASDAQ up 337 on Friday. That was a gain of over 2%. So you can see on a relative basis, money rotating back a little bit more toward the NASDAQ, which is good. We want to see that rotation back to the more aggressive areas. And that's essentially what the NASDAQ represents. Small caps, S&P 600 up 1.25%. Mid caps up 1.4%. That was much better than earlier in the day. You can see the small caps actually in negative territory until about 11:30 in the morning. And then we rallied later in the day, which is becoming somewhat of a theme here over the last 5-6 weeks. Maybe not quite that, maybe 4 weeks. But we'll talk about that a little bit more in the show as well. Got an interesting chart on that to show you. Volatility index. Remember, we're up in the mid 50s. Well, in just a couple of days, we've been able to bring it all the way back down to 37. Still very elevated, still very dangerous, but certainly better than 55. So it was nice to see the VIX come back down. It was down almost 8% on Friday, bring it back down to 37. In my opinion, we're not confirmed out of the woods until we see that VIX go down below about 16. So we got a long way to go still. So don't think that this crazy party is over yet. This volatility party, whatever you want to call it. Lots of ups, lots of downs, and I see some of that continuing probably over the near term. Looking at the major indices for the week, the NASDAQ gaining 7.43% for the week, S&P 5.7%, Dow right around 5%, mid caps 2.8%, transports 1.9%, and the small caps 1.75%. So you can see a lot of disparity, a lot more strength in the large cap names versus small cap. And again, I think until we get back to a point where the market is expecting rate cuts, probably going to continue to have problems in the small cap and mid cap arena. It didn't help on Friday when we had that consumer sentiment reading come out so low. I think the reading was at 50.8. But within that reading or within that report, also inflation expectations, annual inflation expectations were expected to come in at 5.1%, which was similar to last month, which was 5%. And instead, I think the number came in at 6.7%. So expectations, consumers' expectations of inflation going through the roof. It's not coming from me. I don't believe we're going to see that, but hey, we'll all find out together. But anyway, that was part of that sentiment report that the market kind of shrugged off on Friday. I mean, we had a really nice day on Friday. The other thing that shrugged off is the fact that China came back and retaliated again with the tariffs. And the market said, we're not really worried about that anymore. So there are definitely some signs that the market is starting to take some of this bad news in stride because, in my opinion, a lot of it's already built in. The stock market isn't really reacting to what it's seeing today in terms of news. The stock market projects it. Stock market looks ahead 6 to 9 months. And so when I see the market start holding up with bad news, it starts telling me the market's past all this bad news and it's thinking more about where we're going down the road. 6 to 9 months takes us into the end of the year. The Fed has even said that they, are still looking at cutting rates later this year. So if the market believes that, then I think you're going to see the market rebound off of these lows. I'm starting to get much more bullish. I sent out a little bit more of a bullish note on Friday through my partner, John Hopkins, who wrote our daily market report on Friday. But I had talked to him about it, some of the signs I was seeing. And I'm starting to see some pretty good signs in the market. Doesn't mean we're not going to keep, that we're not going to go back down again, maybe put in a double bottom, maybe even pierce that low a little bit. But I'm starting to see enough signs that tell me, and this is the way I evaluate the market, it's not so much that I'm going to try to guarantee what the stock market's going to do. I start to get a feeling for, is it more risky to be in the market or is it more risky to be out of the market? And I'm starting to believe at this point that it's riskier to be sitting in cash right now than it is to be in the stock market. Again, doesn't mean we won't go down short term. I talked about this back in 2022 when the market was bottoming, and I said the same thing. I was calling a bottom. Not really calling a bottom here. I'm just feeling, again, from a risk perspective, that it makes sense. It's starting to make sense to be in the market after we've seen this drop to the downside. And anyway, I got some other charts I'll show you in just a little bit. Sectors. Look at the top 5. Something really good about that. Not only did we rally, but in previous rallies, we've seen defensive groups leading. Look at this rally last week. Technology, the most influential group in the market. 30% of the S&P 500, and it's outperforming. So nice to see technology doing well, but look at the top 5: technology, industrials, financials, communication services, consumer discretionary. The 5 aggressive groups led the action last week. Now that's normal when you are going higher. That's what I look for, but we haven't been in normal for the last couple of months, two months anyway, going back, well, maybe a little more than 2 months, back toward the end of January, into February. That's when I started saying, hey, we get some issues ahead. Talked a lot about money rotating into defensive areas, negative divergences, sentiment had been a little bit too bullish. There was just a lot of things starting to pile up. And so I was talking cautiously for probably a good month or close to a month. And then remember, we had that really big down day. I think it was like on February 23rd. We topped on the 19th. But then we had that big down day on the 23rd where consumer discretionary stocks versus staple stocks, it was like night and day. So discretionary was getting killed all day long, selling all day. The XLY was going down, and all day the XLP was going up, discretionary versus staples. And so that type of behavior, I think that was like the 10th worst day. I can't remember if it was 9th or 10th worst day on record between those two sectors. So the underperformance intraday was the 10th worst on record. And the other 9, 8 of them were in bear markets, and 1 of them was in a correction. And that was right near the top when this happened. And I said, that confirms the top. We're in trouble. What did we do? Market sold off. We did eventually get to 20%. We did actually, it was part of another bear market. So now it's 9 out of 10 times. So anytime you see the discretionary stocks during the day, not at the open, during the day, while the market is open, when you see that discretionary group go down like that and staples going up, that is not good news for the market. That is massive rotation from aggressive to defensive areas. So I said it at the time, but remember it. It's really important to learn from these. When you think back and you say, well, I wish I'd gotten out back in February. Well, learn from it. When you see it next time, that type of movement, it's now been 10 times where we've seen selling to that extent in discretionary versus buying in staples. And in all 10 instances, that has been part of either a correction one time or a 20% drop or more, bear market 9 times. That's the poster child of Wall Street getting out before you and me. That's what that is. That's what you should be thinking when you see something like that. Anyhow, seeing the opposite, we're now seeing money rotating back into the aggressive group. So that's positive. I mean, yeah, market was up, but again, we've seen the market go up. We've seen poor behavior. I think the prior week when the market was down so much, technology also led that week on a down week. So it might have been part of my win. It might not have been the Monday through Friday. It might have been a Wednesday to Wednesday. It may have been when I was doing the stock charts show this past week. It might have been that week from Wednesday or Thursday through the Wednesday. Anyhow, my point is technology has been doing a lot better. And with it being 30% of the S&P 500, that's kind of important. All right, I wanted to show you the S&P 500 here, just the last year, and I wanted to show you all 9 of the aggressive and defensive sectors and just kind of point out a few things. So here is just the last week. See how we bounced off on the S&P 500, bounced off 4,800, got almost back to 5,500, settled in at 53.63 at the end of the week. So we had a move down first 2 days of the week and then rally the last 3 days of the week. The technology group actually was going up all 5 days. So even when we were going down at the beginning of the week, we didn't see any further breakdown in technology's relative strength. That's a good sign. And if you look back since the beginning of the year, well, certainly since the February 19th top, this has been the best performance in technology since then. So over the course of almost 2 months, last week's performance was the best relative performance that we've seen on the technology group during that period. So we went up here. I thought discretionary was okay last week. We saw communication services actually down a little bit, industrials up a little bit, financials down a little bit. But look at the defensive areas. Healthcare, big drop. Consumer staples, big drop. Real estate, big drop. Utilities, big drop. So again, we're not seeing that rotation that we were seeing earlier, back in January and February when that money was rotating out of aggressive areas and into defensive areas. Now we're kind of seeing a little bit of flip back the other way. And so again, that to me is just, it's not, our primary signal, but it's another secondary signal that I think is starting to look much better for us. And I'd really pay attention to the technology group over the course of the next week, 2 weeks, maybe a couple months. If we continued maybe to trade in this range for a while, which is possible, a lot of uncertainty still out there. How are the sectors trading against one another? That gives us a little bit of a clue as to what Wall Street's doing. And I can promise you, whatever Wall Street's doing, it's probably not exactly what they're saying when they're on CNBC or any of the other media outlets. So you got to pay attention to the money. Ignore the noise and the chatter and the talk, blah, blah, blah. Follow the charts. All right, so the XLK, I wanted to show you a couple things here on technology. First of all, a really nice reversing candle. We've got a piercing candle coming in last week off of this downtrend. So the low is going to be really important. And it's not only going to be important because it's part of a reversing candle, it also came down into a key area of support. So if we go back here to the top at 2022, draw a nice little horizontal line there. And then what about this top right before we had this correction in the summer of 2023? And we draw lines at those tops because when you go through, coming back down, they should represent some key support. Look at where the reversal took place. We went right down on the technology, the XLK, almost right down to test the top of 2022. And reversed back up and finished above both of those tops. So that was kind of a key kind of kick save at a pretty important support level, or a couple of support levels, 170 to 180. Now, if we start going back down again and you see that XLK go back down below 170, 169, 168, I mean, we still want to look at it on a relative basis. This is an absolute chart. So it could be that it maybe goes a little bit lower on an absolute chart, but still showing relative strength. So the S&P might be going down, maybe it goes below 4,800. It's possible. But if it does that and technology is still showing relative strength, I would view that as a positive, even though the market's down. Because again, I'm trying to figure out where we're going to be, not necessarily where we are right now. That's the problem with most folks when they're investing, is that they can only look at what's happening right now. If I'm losing money and I'm now losing more than I was a week ago or 2 weeks ago, I can't take any more. I'm getting out. And unfortunately, that's usually a mistake. That's how Wall Street accumulates all their shares. They rely on you and me panicking out while they're manipulating. They're getting out of aggressive groups at the top, getting into more defensive groups. And then as we're bottoming, they're doing the opposite. And if we did that, we'd be fine, but we don't. Even when I talk about a top back in February, I think human nature is, well, things are still going okay, so I'm fine. And then after it rolls over and we start seeing that big selling, the VIX spikes, then all of a sudden it's too late. A couple more things I'm going to go over in just a minute, but for those of you that are new to Earnings Beats or those who have been following me for a while, if you go over to earningsbeats.com, we have a free trial to our paid service. You do have to provide credit card, but we will reach out to you before your 30-day trial expires and make sure that you want to stick with the service. We don't want you paying for a service that you're not using or that you don't value. I can tell you most of our members, I think, are pretty satisfied based on our calls over the year, based on our guidance, our education, our research, some of the things. We just look at the market different than everyone else. And I think that's a really good thing. Anyway, if you go down, scroll down, if you're new to us and you just want to kind of check out a little bit more about us, we do have a free newsletter that does not require a credit card. Just a name and an email address. Hit that subscribe button. We have these come out Mondays and Wednesdays. It's really not a newsletter. It's more of a, I always say it's a chart and 2 paragraphs. That's all it is. And usually it's something talking about relative strength, earnings gaps, could be sentiment. I could have the S&P showing trend lines or moving averages or whatever. But we try to make it very educational. I think you'll enjoy it. There also will be stocks that you can trade from time to time if you're interested. I put in some setups, but that's, if you decide to trade, obviously that's completely up to you and your responsibility. But anyway, check it out. I think you'll enjoy that free newsletter. And then, of course, our paid service again. It's amazing how much we provide for our paid Earnings Beats members. So check all that out. And also, if you like the video, hit that like button, subscribe to our channel. That'll help us in non-financial ways. That'll help us with algorithms on YouTube and so forth. So if you like us, but for whatever reason, you don't want to subscribe, that's fine. Give us some love on YouTube. Hit that like button and subscribe. Love to have you. All right, a few more charts. Now, one of the things I talk about when you get into a very emotional, volatile market is that usually sentiment marks bottoms. It's really hard when the VIX gets up to 55. I mean, you know what you saw last week or the week before. I mean, the market sells off. It's, just trying to think of the right word, indiscriminate selling, just continually, everything sells off. Everything sells off at about the same rate. If the market goes down 5%, you look at your stocks, most of them are down, somewhere in the 4 to 7% range. It's just like everything goes lower. And I had my phone, I was looking at my phone one day when the market was down big, and every one of my stocks, I had a 1-day chart up, and every one of them looked the same. It was like down, back up a little, down, back up a little, down. Every single one of them had about the same pattern. It wasn't like some were down, some were up, some had gone sideways for a while. I mean, every chart had almost the exact same pattern. That to me is indiscriminate selling, compulsive selling, or impulsive selling. And usually you want to be out of the market then. That's market makers being on vacation. That's what I like to call it. They're not providing liquidity, and they can't. There's too much volume. They do have limited resources. So they wait until things get so crazy, people start panicking, and then they'll start to commit their capital, knowing that other Wall Street firms and so forth will follow suit. And that's the way the market works. Round and round we go. So here on this S&P 500 chart, this is a monthly chart that goes back 30 years. And I want to show you the spikes in the VIX. So the volatility index is what's considered expected volatility. And the readings on here are essentially, it's kind of a, it's a formula based on the short-term options, short-term S&P options. And so market makers set the premium on those options. And the premiums, the higher the premiums on those short-term options, the higher the VIX. So when you see the VIX starting to jump, basically it's the market makers telling us to expect more downside action, especially once the VIX gets up above 20, 25 and starts to accelerate. That's when you see the biggest losses. That's when the market just absolutely craters. So you don't want to be in during that period. I mean, I think hopefully that goes without saying. But if you look at all of these spikes, and I just put a line across here, a horizontal line at 40 on the VIX. So going back since, over the last 30 years, here are the periods where the VIX has gone above 40. And I'm also showing you arrows of where the S&P 500 is at the time. Now, if you look at this, if you happen to catch a peak on the VIX, you're essentially catching the bottom or pretty darn close to the bottom in the market. Well, look at where we just went up to, it says 60. I remember seeing like 55 or 56. I don't remember seeing 60. I think the 60 printed like at the opening bell, but I never really saw that intraday. But anyway, 55 is pretty darn high. You can see there aren't too many cases over the last 30 years where we've gotten up there. When we have back in early August, remember we had, I think the small caps lost 15% in 3 days. There we saw the VIX spike up to about 65. And that also put in a short-term bottom. We had gone down to about 5,200 on the S&P 500. And by, 5 months later, we were over 6,000, 6,100. So that was a pretty nice bottom there marked. How about here in 2020? We already know what happened with the pandemic. Everybody panicked out. Market came roaring back. 2018, beginning of 2018, had a little spike, and we went sideways for a while, but 6 months later, we were significantly higher. 2015, you can see the spike up to into the 50s. Maybe 6 months later, we came down, went slightly below it, but really nothing significant before we went up higher. How about 2011? Got up to in the 40s on the VIX, right as we hit the bottom. 2010, same thing. We had a spike up to about 46, 47, right before we made a move to the upside. 2008, the highest level, we got up to near 90. Here's one where 3 months later, we actually were a little bit lower. But look at the VIX. The VIX had come down significantly. So even though we kept going lower, fear was coming out of the market. And look what happened afterwards. Big rally back. Go back into 1998. I think that was a flash crash. Market fell 20%. The VIX got up to 45. And from there, we soared. 2001, we had a VIX spike up into the 40s. And that one, we had a little bit of a bounce, but we ended up going, I would say, more significantly lower. That was the only time in the last 30 years that I have seen the VIX jump up into this 40, 50, 60, 70 range and then go considerably lower after that. It's just not the way the market works. When we get so fearful that the VIX is up into the 50s, we're either at a bottom or we're really close to a bottom. Maybe we go back down and test the low. We've seen that on a few occasions. Maybe we go just a little bit below, but history tells us that we're either at the bottom or we're pretty darn close to it. So to me, getting that VIX up into the 50s is one of those sentiment signals that's telling me we may not have bottomed, but we're probably darn close to a bottom if we haven't already said it. Another sentiment indicator, how about the 5-day moving average of the equity-only put-call ratio? Now, I didn't go back and mark every single one of these. This is going back 17 years, 18 years, all the way back to 2007. Couple things maybe to point out on this chart. First of all, there are some differences over at the CBOE that I'm not sure what's going on. I've been communicating with Julius de Kempenaar, who is over at Stock Charts, and he's in charge of data. He works with CBOE and some of those. So he's now shown me that Stock Charts is doing exactly what's coming from CBOE on the market statistics page each day. The problem is over at CBOE because there was a day where market statistics showed the equity-only put-call ratio at 0.64. But when you went to the intraday half-hour readings of that equity-only put-call, at the very bottom, the last one, the cumulative reading for the day showed 1.17, and it was a massive sell-off that day. I think it was the day that we hit the low. And so it didn't make sense for an equity-only put-call ratio to come in at 0.64, which is what was reported in the daily market statistics page. which is what stock charts picks up. And so that's why right now this 5-day reading is never reached what I consider to be kind of extreme pessimism, where the 5-day moving average gets up to about 0.75 or 0.80 or even more. 2009, this was actually or 2008, this was the highest reading on record. No, there was another one, may have been earlier. There was one reading that came in. It might have been, maybe it was an individual daily reading. Maybe it wasn't the 5-day, at like 1.35. And I think during the pandemic, we got up to about 1.05 on the 5-day, and that eclipsed 2008, where we got to about 1.02. Now, I think the readings now are much worse than what this is saying. This is telling me 5-day moving averages at 0.63, and that all we did during the extreme panic was go to 0.73, which is this just below that green horizontal line. So Julius told me he's going to talk to somebody over at CBOE and try to find out why their cumulative half-hour readings, the total for the day, was 117, and why it's being reported as 0.64, because that's that one day, what was it, 50 off, a little bit more than 50 off over a 5-day period. That would be another 0.10. 0.73 would actually be 0.83. But that wasn't the only day. The day that stock charts was reporting 1.01, that half-hour reading over at CBOE was like 1.33. It was one of the highest readings on record. And yet again, that's not what was being reported in that daily market statistics page. So my point of all this is I don't really trust this reading. I think it was much higher than what we're seeing, and would have marked on this chart very similar to what it's marked on many other major bottoms. There's 2000. Look at that huge spike. You have to ignore this massive 5-day spike at the end of 2022. Tell you why in 1 second. If I can get this top off. There we go. All right. Back in 2020, late 2022, and I think even again, maybe into late 2023, but certainly in 2022, I read some articles about hedge funds that were trading equity puts on some of the Mag 7 names, massive numbers of equity puts, which was skewing our readings, because what we want to do and what I'm trying to do, the VIX kind of tells us what the market makers are seeing. The 5-day moving average of the equity only put call ratio gives us an idea of what retail traders like you and me, what they're doing with their money in the options world, because they usually get it wrong. When they all start getting very bullish and trading calls, that's usually when we're about to top. And when they're all getting very bearish and they're trading puts, that usually is a sign the bottom's in or coming very soon. And so that reading right there, where we went up over 1.4, I mean, first of all, look at the market had already bottomed and we were heading up. So the fact that much of the fourth quarter here, we had really high 5-day readings. I mean, the fourth quarter, we were going up. That's not when you get folks panicking and buying a bunch of puts. Market's going up, usually you get more and more calls start being bought, not puts. So that was what alerted me back then. And I started doing some research and actually found an article someone had written saying that there were unusually large amounts. And so I started looking for them and I started seeing them. They tended to be on Wednesdays for whatever reason. I don't know why Wednesdays, but they tended to be on Wednesdays. And it usually was right in the middle of the trading day. And all of a sudden you'd see massive spikes in the number of puts. Usually options volume slows down the middle of the day. And so it was really easy to spot when you would go back and look on the half-hour chart, because all of a sudden, at 12 o'clock or 12:30 Eastern, you'd see all of a sudden 500,000 puts showing up, where normally it would be around 100,000. And so that would massively skew the equity only put call ratio. So puts are on the top, calls are on the bottom. Puts are numerator, calls are denominator. So when a lot more puts are being bought, the fraction starts to go up. When it's really complacent, sometimes we get readings like at 0.4. So you might see like 2 puts and 5 calls being traded. Not literally 2 and 5, but maybe 200,000 and 500,000. And so that's a 0.4 reading. But if you go up to 400,000 puts versus 500,000 calls, that's 0.8. So when you start seeing puts, as many puts or almost as many puts being traded as calls, that is usually what happens when the market is tanking. And when you get to extreme 5-day moving averages, that's when you're getting pretty close to market bottoms. So anyhow, I just wanted to point that out and just say I don't think that these numbers are exactly right. And I'm looking into it. Stock Charts and Joyous, good buddy of mine, he's looking into it. And when I find out what's going on, I'll certainly pass it along to everyone. The next chart I wanted to show you, and this is the one, remember we were talking about consumer sentiment beginning of the show, how consumer sentiment came in near all-time lows or, near lows of the last 50 years. Well, here they are. This is an area down here from 0.50 to 0.65 that I've highlighted. And the reason I'm highlighting them is I want to show you when we've reached the lows at these various times, including now, I want to highlight what happened to the S&P 500 after those readings. So the first time in the last 50 years that we saw it go down to 0.50 was at the beginning of 1980. That was the start of a 20-year secular bull market, probably the greatest 20-year secular bull market in our history. And that started when the sentiment was at 50. Think about what sentiment means, this kind of consumer sentiment. If you're already feeling so horrible about things, you probably would have sold out of the market, wouldn't you? I mean, if you think things are so bad and that we're never coming back and that this is the Great Depression 2.0, we're about to go into a recession, maybe worse, economy's bad, inflation's going up, throw out stagflation. Why not? Let's throw that out there. When you get to readings like this, these extreme consumer sentiment readings, folks are already selling. They've already, in my opinion, sold. What are you waiting for? If everybody is so negative about the market, are you still holding on to why would you keep holding on to your stocks if you're that negative? So I believe when you start getting these low readings, it marks major market bottoms. And look at this chart and tell me I'm wrong. Here is the 50 reading in 1980. Here was lower 60s in 1982. Here is 65 in 1990, right at the end of the Persian Gulf War and that recession, right at the bottom. And then the market took off from there. Here is 2008. So here's the financial crisis. We lived down in the mid to upper 50s back then, but the lowest reading that came in was right here. Now you could say this would be an argument for the bears. I try to be objective. I didn't mark it because I went with the low here in this period. But if you look at the prior low, which would have been in the middle part of 2008, we did have substantial selling come in after that. So I'll throw that one out there as one that is a check mark for the bears. But here was one in late 2008. We did go a little bit lower after this one. But if I'm going to give the bears this other one here at 56, 57, I guess I should give the bulls the one at 56 because that came in almost right on that March low. Then how about 2011? We got back down to 56. That occurred basically at the midsummer 2011 low, right before we had a massive rally. How about 2022? We came in middle part of June. Remember when I said I'm calling the bottom? If you forget, here's my YouTube video. I'm calling the bottom in the S&P 500. Couldn't be much clearer. That was 2 years ago. It was June 16th, 2022. Market actually went a little bit lower in October of that year, but we weren't below that June 16th low very much over the balance of the year before we took off again. But that was another signal back then where the sentiment was just crazy bearish. And so you've got, reading on the University of Michigan consumer sentiment down near 50. Basically, we went just slightly lower in October of that year. And then what happened? Big rally. Now we're pulling back. we're hitting a key support, that 4,800 high from 2022, right before the cyclical bear market. We broke out above it. And guess what? Over the last couple of weeks, actually earlier last week, we went right down and tested it. We got down to 4,830. I think that resistance area was around 4,800 to about 4,819, depending on whether you're looking at closes or intraday moves. But we went down, tested it. And with this reading now at 50, I mean, maybe it goes to 45. I don't know. I have a feeling after the inflation report that we just got this week, and with the tariffs, the 90-day pause, my guess is that you're going to see this consumer sentiment number bounce off of 50 again. So did we bottom? Maybe do we have a little bit further to go? I mean, it's all possible, but I'm going to give you one final thought, and then we're going to let you go here. QQQ also back on this video. I'm pretty sure if you went back and watched this video, you would see some of the manipulation that I talked about, where we were still going down in June from the May 2022 low, but we were gapping down and we were seeing buying throughout the day. That was one of the things I talked about over and over and over again back in May and especially in June of 2022. I said, listen, we're going down, but Wall Street's accumulating. And I'm seeing the same thing over again. So here is the latest readings of the QQQ. So you can see back in the beginning of 2025, we made a move up. We were getting a lot of gap ups to make that move. And then intraday, we were actually selling off. So that was part of what was going on with Wall Street getting out of stocks. That was the first part. This second part looks much more bullish. We gapped down 21, but we were actually buying during the rest of the day up 14. And all I'm doing is netting all the gaps during these periods and just posting them as one number. And then I net the rest of the day and post that as one number. And it covers the period that's shaded. Hopefully you can understand that. But what happened when we were rallying in the afternoons? You remember when I was talking about late January and into February, what was happening in the market? Money was rotating into defense. So yeah, we were going up. And this part down here maybe looks like it was some bullish move it wasn't. It was rotation out of the aggressive groups and into defensive groups. That's what kept the market going back then. So that was the warning sign. That was the exact same warning sign we talked about in December 2021 before we had the bear market in 2022. And so what happened? We ended up having a bear market again. I thought it was going to be a correction, to be honest. But we sold off. And like I said, when you start off, even in 2022, I said I thought our initial target was going to be down at 4,300, which would have been maybe just on the brink of a bear market. I don't know if it would have made it. It probably would have been just shy of a bear market at that time. But once we started selling, the signs were that we were going lower. And so you adjust, and that's when, eventually we hit my bear market target that I had talked about at the beginning of 2022. Anyway, this period right here, this red shaded area, this is what I call pure distribution. We had netted going down gaps, but then look at the rest of the day. During the day, do you see all these red filled candles? That is pure selling all day long. Red filled candles mean you're opening toward the high of the rectangle or at the high of the rectangle, and you're closing at the low of the rectangle that's filled with the red. And so you see a couple hollow candles, which is the opposite. You're closing above the open with the hollow. But look at how many of these big red candles we saw. Pure distribution, selling all day. I've actually given an Excel spreadsheet to our annual members at Earnings Beats that highlights. I even break this down during the day between opening gaps from 9:30 to 10:30 Eastern, or 9:30 to 10 Eastern, 10 to 11 Eastern, 11 to 2 Eastern, and then 2 to 4 Eastern. So I don't just say rest of the day. I break it down. Every time period during this red shaded area, every time period was negative. The gaps, the first half hour, the next 3 hours, and then the final 2 hours, all were showing net selling. And so that's just pure distribution. But here, check out what happened here. During this period right here, we went from about 468 to about 477. So like we were up maybe $8 or $9 during this period. The gaps were down $17. The buying intraday, look at all these hollow candles. Buying intraday was $25. So yes, net we went up 8, but market makers were forcing a lot of retail traders to sell at the opening bell. They were manipulating folks at the opening bell and a little bit early in the trading day. And then we had buying the rest of the day. Wall Street, when everybody else was selling, Wall Street's buying. And how do I know this? Well, look at the consumer sentiment. We just saw the reading went down to 50. So during this whole period, people are getting more and more and more and more bearish. They want to sell, and they are selling. And market makers and Wall Street are saying, thank you. We appreciate your shares very, very cheap. This latest move to the downside, all the way to basically set that bear market low. Look at the gaps, minus $32 net gaps. This is just over a 7-day period. We netted gapping down $32. That's an average gap down of about $4 or $5 a day. Look at the buying over the rest of the day, $22. So just think about over the since the middle part of March, we've had gaps. Now, by the way, I shouldn't have shaded all the way over through Friday. This was only updated through the 9th, which was after the huge hollow candle. But it looks like it even got worse or better, depending on how you're looking at it, more accumulation over the last 2 days. Because look at the low intraday on Thursday, and then the long tail. We came back up, finished a little bit below the low or below the open. But then look at Friday. We gapped down, went a little bit down intraday in the morning, and then rallied back, finishing near the high. And that hollow candle is bigger than the red filled candle. So I would say these numbers have gotten even bigger. But since the middle part of March, gaps, add up these two. That's $50 or $50 worth of gap downs since the middle of March. In 1 month, the S&P QQQ has gapped down $50 cumulatively, net. All the days combined together, we've gone down $50. Rest of the day, we've gone up 47. So we have gone, actually I've done something wrong in my math. Because that would mean that overall we only went down $3 from here, but it looks like we went down $13. So I'm going to say one of these is $10 off. I'd have to go back and double check. It doesn't matter though. I mean, look at this, $50 gap downs and 47. Okay, maybe it's 37. We came back up. But the point is, market makers are essentially, taking everybody's arm and putting it behind their back to say uncle and to sell. Market makers are buying for their Wall Street friends. Well, market makers are Wall Street. I mean, they're part of the big Wall Street firms, but they're buying for their high net worth customers. They're buying for, other institutions, other pension funds, things like that. That's where market makers and their responsibility or what they do is try to provide the best possible price for their institutional clients. And they do it all at our expense, you and me. So, I mean, you all can do what you want. You can swear the market's going down a lot more. Maybe it will. I certainly can't guarantee anything. But I told our members that I was back in the market on Friday. I was already getting back in. I got in on these big down days right here. It was last Friday and I think Monday in the morning. So I didn't get it right at the bottom on the first. I think this was Friday. And here was Monday. Monday, I got in pretty low. And I'd gotten back to about 50, 60% invested. And then after this big day and then this drop coming back down, I was like, to me, it's not worth the risk to be on the sidelines. Because I think the market could, I don't know it will, but I think it's just as capable of flying back to the upside as it is to go back down and set a new low at this point. And so I'm not taking any chances. If we do go lower, so be it. I was out of the market for a while. I saved during that period. If I end up going down for a period of time, it's okay. Essentially, I said the same thing back in June of 2022, and we did end up going a little bit lower later in the year. So I'm not guaranteeing that this market doesn't go down, but sentiment has a history of marking bottoms. And as I showed you, between the sentiment, between this manipulation, I see the market going back up in time. So with that, I will exit, and I will see all of you next week. Happy trading.